Hey, what is going on, guys? My name is Nick, and in today's video, I'm going to be sharing my investing plan for 2022 and how I plan on beating the overall returns of the stock market. Looking back, 2021 has been quite a wild yet incredible year to have been invested in the stock market. The S&P 500 is up 27% year to date, while many of the biggest and best companies in the world outperformed this substantially. We've also seen rallies to the moon in certain meme stocks and crypto coins before tumbling back to reality, just highlighting the absolute insanity of the stock market in 2021. However, given the uncertainties around COVID, supply chain issues, and inflation, while stocks are still trading at all-time highs, nobody can predict what's going to happen in 2022. And frankly, nobody can ever accurately predict the stock market over the short term, which is why I've developed this investing plan for 2022. It doesn't involve any types of predictions, no. Rather, it's a stock picking methodology to try and outperform the market in any economic environment. So if you do gather some value from this video, make sure to drop a like, and if you haven't already, make sure to subscribe so you don't miss any of my future uploads in 2022. I wanted to let you know that I recently started a Discord community of investors where we talk about all concepts related to investing, stocks to buy, different investing strategies, and so on. So if you are interested in joining and learning a lot more about investing a lot faster than watching YouTube videos, definitely check out the link in the description. Anyways, let's jump into my investing plan for 2022. Alright, so the first part of my investing plan for 2022 is to build up cash and invest consistently. Leading into the new year, I plan on gathering as much cash as I possibly can to be able to then deploy into stocks throughout the year. And I think it's very important to talk about this personal finance aspect when it comes to investing, because oftentimes a lot of us don't even have enough cash to be able to invest. Being frugal is probably going to be a very good strategy for building up cash, but also taking on additional side hustles or working extra hours at work, being able to build up your cash reserves in any way possible, even selling some other assets that you might not need or personal belongings around the house. This is a great way to build up your cash reserves to then deploy into the market. And a great resource that I actually use for managing my own personal finances when it comes to investing is the Mint app, and that allows you to figure out your cash flow at the end of the month, and that would be the amount you can then invest. And secondly, I plan on investing this money consistently throughout the year. And this will first start out by maxing out my tax-free savings account, or my TFSA contribution room, of $6,000 that starts on January 1st. Now, for most of you, this should be the #1 priority if you're living in Canada, but if you're in the US, the same thing goes for a Roth IRA, so you gain another $6,000 of contribution room, and that should be utilized immediately. So now, what do I mean by investing consistently? Well, basically, whether the market goes up or down over the short term, I'm going to be investing regardless. And this is a concept also known as dollar cost averaging. This is where you invest a specific amount of money, say $1,000 every week, every month, or every 3 months, but the whole point is to continue investing consistently on that schedule. So for me, I get paid at the end of the month, so every time that I invest is usually at some point at the end of the month or at the start of the next month. But you can find a schedule that works for you. It's just really important to remember to consistently invest throughout the year, because you never know what's going to happen in the stock market over the short term. And with that said, let's get into part 2 of my investing plan for 2022. Alright, so in 2022, I plan on being highly selective with the stocks that I pick. Therefore, I'll specifically be looking for undervalued and profitable businesses having little to no debt. As intelligent investors, it's important for us to understand the difference between true value and hype in the stock market. This means not caving into FOMO when it comes to hot IPOs, meme stocks, new crypto coins, or even overvalued stocks going to the moon simply because of unjustified optimism. Instead, we should be looking for businesses with solid fundamentals that justify their valuations, or even better, companies that are trading below their intrinsic value. As many of you would know, I perform intrinsic value analyses on most of my stocks before I buy them, where you can actually access the spreadsheet via my Discord community of investors, link below. In addition, I'll be continuously watching several valuation metrics for stocks to buy, which include the following. First and foremost, the price to earnings ratio, but secondly, the price to earnings growth ratio, or the PEG ratio, representing if a company is at good value compared to the expected earnings growth rate over the future. Finding solid companies with a PEG ratio below 1.5 generally provides pretty good value, and I plan on sticking to this methodology for the most part throughout 2022. For instance, Meta stock is trading at a PEG ratio below 1 right now, showing incredible value for its earnings growth. Also, another company I've been talking about is Visa, which has already come up from when I first spoke about it, but it is still trading at a PEG ratio of 1.5. On the other hand, I'll be avoiding stocks that are trading at sky-high valuations right now, like Costco being at a PEG ratio of 5. Even though I would absolutely love to own Costco stock, I just can't justify buying it because there are better opportunities in the stock market. Now, the two other major criteria that I spoke about earlier are that the companies have to be profitable and they must have little to no debt. I've learned over the past year that buying profitable companies is a much better approach to investing, and it's much safer than buying unprofitable companies, and they can still provide excellent returns. The same is true when it comes to buying companies with very little debt versus those that are loaded to the sky in debt, especially considering that interest rates are expected to rise over the next few years. As Peter Lynch says, a company without debt cannot go bankrupt, so I plan on following this philosophy throughout 2022. Finally, in terms of valuations, I'll be watching analyst price targets and upside potential in the stocks. With every stock that I analyze, I'll be making sure that analysts agree that there's going to be greater than average upside potential in the stock. Now, we all know that analysts aren't always right, but you can generally get a pretty good idea of whether a stock is a buy or a sell based on the average upside potential. So I won't be relying on those estimates, and I would recommend that you don't either. Always make sure to do your own research on any company that you buy, but it's always good to see when analysts are agreeing with you and see huge upside potential. So overall, in 2022, I plan on buying undervalued and profitable businesses with very little to no debt, and hopefully this strategy can outperform the market. I guess we'll have to see at the end of the year. Finally, in terms of the types of companies I'm going to be looking for in 2022, these will generally be inflation-resistant and scalable business models having some sort of competitive moat. On December 10th, the inflation data was just released for November of 2021, which came in at 6.8% year over year or 0.8% month over month. This topped last month's 6.2% inflation, which was already the largest increase over the past 30 years, which is very concerning. So naturally, I'm going to be focusing on companies that will continue to do very well during times of inflation. These could be companies that are natural hedges against inflation, like Visa, for instance. Since they earn a small percentage off of each transaction processed on their network, this amount will grow with the rising price of goods and services. Another natural inflation hedge company is TD Bank, which benefits from rising interest rates. But I'll also be continuing to invest in some of my top companies, such as Meta, which has actually seen a huge increase in the average price of an ad throughout 2021. Meta has continued to be able to increase its revenue year after year as the average revenue from each of its users continues to rise accordingly. And the same goes for Google, which saw incredible ad growth over 2021. This should continue growing as inflation persists over the near term. But the other part about these companies that I absolutely admire is the fact that they're scalable and they benefit from what's called network effects. Warren Buffett says that one of the best types of companies to buy during times of inflation are those that can scale their businesses at a very low cost to generate more revenue. Visa, Meta, and Google all don't need to spend that much money to be able to obtain new customers or generate more revenues, which means that as their businesses continue to grow, their earnings are going to continue exploding. In addition, they benefit from what's called the network effect, where basically their businesses become stronger as more people join their services. For instance, the more cardholders there are on the Visa network, the more merchants that will want to join and take advantage of those cardholders' business. Or even the more users on Facebook and Instagram will naturally increase the number of advertisers on the platform to be able to reach those users. So network effects end up creating strong competitive moats for these companies, allowing them to continue growing year after year without question. And when it comes to Google, this company has more than just a competitive moat. It essentially has a monopoly. Google has been able to maintain a market share greater than 90% over the past decade because of their continuous improvement using AI, as well as their brand recognition. So just like network effects, brand recognition is another great factor that can lead to a competitive moat, which I will be looking for. Overall, in 2022, I plan on buying businesses that can rise with inflation, they're scalable, and then they also have some sort of competitive advantage to be able to protect them from competitors. Anyways, that is my investing plan for 2022, so I hope you enjoyed it or gathered something valuable from it. But yeah, if you did enjoy the video, make sure to drop a like. It does really help out. And then if you haven't already, make sure to subscribe down below so you don't miss any of my future uploads. And with that said, I will see you guys in the next one.